Good morning, ladies and gentlemen. Well, the risk dial closed at 77 on Friday, and the only thing that's slightly worrying is that we are making lower highs in the scores with higher highs in the market, but that is not something which is immediate or worrying per se. We're seeing the weekly model do exactly the same, with the moving averages coming in as opposed to going out, which shows us that we're in a very late stage of the cycle. But that is not something that is immediately worrying. We will examine in detail what is immediately worrying, but for the time being, I think it's safe to say that the equities will far outperform bonds. The only question is how far bonds will go down and what the relative performance will be. Will it be a positive relative performance by equities, or will it be relatively less positive? But as always, we start with what the bond market is telling us. And this is a daily chart of the 5-year note yield. And as you can see, it basically has been offered all week. The refunding announcement was not enough to spook the market, as I was hoping it might be. We just did not get that kind of a huge announcement that I was hoping for, and we closed below 796, 79.6 basis points, which says that the pressure might continue to be on the shorter end, i.e. the shorter end might continue to go down in yield or not go up nearly as much as the longer end. What can one say about this kind of performance? This could be just an ABC and we continue up, but in general my view of bonds is negative. It's just obviously that the shorter end will perform better than the longer end. If we have a look at a 10-year, the performance here is much different from the 5-year. We tried to go down below 151 in terms of yield. We failed, and we closed with a huge doji candle on Friday, indicating to me that the pressure is going to be towards the 169 level, i.e. continued steepening. But the worst part was in the 30-year. You can see how we actually took out. If I enlarge this, you can see how we actually took out the previous day and did a key reversal. This to me screams a steepening of the curve and yields going up towards this 237 basis points level in the weeks and days ahead. Basically steepening, and a steepening which is could be quite dramatic and have dramatic effects on a lot of assets. TLT did absolutely nothing in terms of the weekly performance, but that in itself is worrying. If we can't go any higher than what we have seen, that all the pressure is going to be down on the downside. And I think at some stage we trade this 127.37 level, and I will show you later on how this level actually matches up with what happened in 2014 when we had the reverse of what we're having now, and that is the big commodities dump, while now we're having the big commodities rally. I still think there's very little to be gained by being long of bonds, apart from on a tactical level. All the pressure, I think, is going to continue to be on the bond market. As to the yield curve, this is where we could see some quite dramatic changes. For the first time in a very long time, we're getting definition in the 2s, 10s. This is a daily chart. I think any break of 147.5-ish basis points will lead us to test the highs around the 157 basis points level. That's quite a 13, 20 basis points different in 2s, 10s is quite a dramatic move that we could be expecting and seeing in the days ahead. Everything is telling me that the yield curve is in a steepening phase now. And let's look at the 5s, 30s and the 10s, 30s. As I posted on Friday, I will never get tired of posting this chart, which is a weekly chart of the 5s, 30s, just to show you how important this 154 or let's call it 156 level is in the 5s, 30s on a weekly close. Remember this period here. Remember the 2014 period, and we will look at what happened in 2014 and with commodities as well, and look how important this period is. Remember this 2014 year, and remember how much the curve here flattened, and remember how much the curve here could steepen. A steepening of that much, from 230 basis points to 150 basis points is a huge move, which has huge effects on asset prices. So remember that. If I show you now a daily chart, you will see that we had these spikes below 154. So we have to be relatively careful, but the weekly close was always inside the 155, 156 basis points. So we need to be careful of that as well. If we look at the 10s, 30s, I told you that I am a great believer in 10s, 30s for it to show us what the market expectations are. If they say that 10s, 30s are stable, then we're not really looking for runaway inflation. We're looking for the kind of inflation that the Fed can do something about and will do something about, i.e. the market is not losing faith in the Fed. Now I think we probably come back down to 80 basis points. We tried very, very hard to break 64, failed every time. The risk reward is that we have a very quick move down to 80 basis points, and that would knock another 15 to 20 basis points onto 30-year bonds. The steepening trend is obvious in Europe as well. This is a chart of the bubble. You can see how it just can't break below this level around 61 basis points, and I'm sure that at some stage it'll head towards 52. Now, I have very little doubt that all these markets are steepening and going up in yield. If we now have a look at the Bund, you can see how it's performing much worse than the bubble, and here the critical level is still this 17 basis points, above 17 basis points, and we're gone. If I change that to a weekly chart, you can see that above 17, and we are going to positive. We're going to 2-3 basis points, that kind of thing. There's very, very little to hold it above 17. You can see this massive area here, which will, it goes back to 2020. So we're going to have 1.5 years worth of trading broken to the upside, and I think that easily takes us up towards just positive yields. If we have a look at a chart of the 10-year Germany against US, you saw the amazing failure On Friday. We touched the level that I said was so important, 175, and closed well below it. So, this is still in a range. And if this is still in a range, that tells me that all bond yields are going to rise, as opposed to the US taking all the strain. And that is actually obvious in this chart, which is the BTP, the 10-year in Italy. As you can see, on Friday, it made a new high on this whole move. And it's quite obvious that we are going to this level, which is just below 100 basis points, 98. Italy is basically the leader here. This is the chart of Italy against the Bund, against Germany. It's quite obvious to me that we are now, we have broken decisively all the levels that I told you about, and we are now going towards these levels around in the mid 120s, from say 119 to 124, 125. It's, the ECB just can't hold it. There's too much pressure. They will try their best, but I don't think their best is going to be good enough. And even if we look at, this is the OAT, France, to me this is really going here to 20, around the 28 basis points. And if we change that to a weekly chart and we zoom out, we can see how important this is. We are basically, if we start leaving behind this level, which we are nowhere near yet, but if we start leaving behind 28, we will be having a target which is around the 58, 59, 60 basis points. A big move. These are very, very big moves in everything, in all the yields in Europe and in the United States. And to me, the pressure is going to still be piling onto bonds. Any dip in yields is an opportunity to get on board. The dollar, as I've been saying for a while, had its worst week for quite some time. And I think it's quite obvious that it's heading, if I enlarge the daily chart, I think it's quite obvious that it's heading to these levels, which are between 89.80 and 89.41. It's going to try and test these levels at some stage. What do I think is going on? I think the refunding, especially in Q3, is going to be so massive that they have to let the dollar go lower. And I think that is the only hope they have of getting so much refunding done at levels which are not much higher, and I mean much higher in interest rates. I think we are playing tag between the dollar and yields. I think unless they want yields to start really screaming higher, which I'm sure they don't, they've got to let the dollar go. And I'm quite sure that we will, this is the weekly chart, and I'm quite sure that on a weekly basis at some stage we will see this 88.44 level, and quite possibly quite a bit lower. Now, this is the dollar. Remember 2014, the period between 2014 and 2015. This was the dollar. We are now experiencing something in reverse to 2014, 2015, and I think that we could, easily have, by the year end, a move down to 84.50. Gold is caught in the middle, as it were. You've got the positive headwind of the lower dollar, and you have, I think, the negative headwind of the higher yield. But that negative headwind, unless bond yields start heading up so much that real bond yields start coming down, could actually turn into a positive headwind for gold. I.e., if bond yields only go up 10 or 20 basis points, but inflation expectations are for 50 basis points, that could actually be a positive headwind for gold. And that seems to be what the gold price at the moment is suggesting. It's not screaming it, it's just whispering it. 1765 to me was the very important level, and we never broke it on a closing basis. Let's enlarge this daily chart. You can see how it just never broke on a closing basis, and finally it broke up. Now, where do we go? I'm sure that we will test the 1760, 1770 level, but we have to start breaking that convincingly for me to have an argument to say that gold has actually bottomed. I think, the odds still are that the move up in bond yields is going to be enough to hold it around this level, especially since the 200-day moving average is coming down. Those odds could change very quickly depending on what this next chart does. And please remember the 2014 year. To me, this seems to be exactly the reverse of 2014. Well, DBC attained my target, which was 1841 that I gave you 3 weeks ago. The high, this high is 1868, and we closed at 1873 just through it. Now, does that mean that we've broken? No, it doesn't. We could easily retrace in the next couple of weeks. But I think that 2-3 weekly closes starts to suggest that we are now, and look, this is 2014. Look at the move in DBC. It basically collapsed once it broke 24.34. It collapsed all the way to where we are now. Now, if this is the reverse, remember what happened to bonds. I can actually show you again what happened to bonds on this chart. If we have a look here and we go back to 2014, the bonds went from 101 all the way up to 137, where we are now. I mean, this happened in the early part of 15, but they touched 127.37. So this seems to me just the reverse of 2014. If we now start breaking up, what I'm saying is that there is nothing between this level and 24.34. We could easily have a massive spike in commodity prices, and that probably would be enough to get gold to start going significantly higher than 1850, 1860, 1870, and actually go into a new bull phase. So what the market is actually saying is that we are having a new commodity cycle. If we have a look at copper, which is the one that I've been telling you about, this is the weekly chart. You can see really now that the very important levels are going to be somewhere around here, around the 510 area. If we break 510, I think in copper all bets are off in how much inflation we're going to get. It could get really quite, quite hairy. And this is the chart of gold over copper, all-time lows, basically. This is the favorite indicator for Gundlach and the bond boys. This is screaming higher yields in the bond market. So just be aware of it. it's all going one way. It's all saying the pressure is one way. Could it reverse? Yeah, sure, it could reverse, but I don't see any reason or fundamental reason why it should reverse. It's all basically beginning to shout that you should be very careful about bond yields, because they could start breaking very, very hard. Wanted to show you this chart of gold over TLT, AIU over TLT. And remember the year 2014. This is when we broke down hard, and this is the level, basically 11. Now, this has been my pivot line for when to prefer gold over bonds for a long time. And if you remember back in the middle of last year, I said it's broken up, favor gold over bonds, and that is when we came up with the equities followed by gold followed by bonds, i.e. that bonds are the absolute worst asset class to own. If this is as I think, a repeat of 2014 in reverse, this is a market that is going to go to somewhere around here, around the 14 level. This to me is the target, around 14, 14 and a half. Still a bigger move, and that is why I'm not so sure that gold can't go up, because if we say that gold does nothing and we are expecting all this to be done by TLT, that's just too big a move for TLT. That is why I'm beginning to think that gold is actually, could start moving up. But what would that imply? That would actually imply that the market is losing faith in the Fed and the Fed's ability, or willingness rather, to control inflation. That could unleash a maelstrom in asset markets. If the market believes the Fed is no longer prepared to control inflation, what price bond yields? I don't know, 5%, 6%, 7%, who knows? And that would be just a complete and utter shock to every asset class. But for the time being, you can see that bonds are still worse than everything. And if we look at TLT against SPY, which there's no need for me to show you, it's just making new highs every day, you can see that the market has not lost confidence in equities. It's just losing confidence in bonds, and gold is still to be preferred to bonds, and there will be a move, and I will now put this in. I think this is the kind of, this is the kind of level that it trades, 14 and a half. This is a big move. And to me, that just confirms that TLT is, an avoid at all costs. I wanted to show you a weekly chart of silver as well, because that is, it's beginning to look very interesting insofar as we had this consolidation, which I will now try and... We had this consolidation here for many weeks, couple of months that we've now broken out of. And this is the level 2470. If this continues, I would expect it to go at least to 2676 and then break higher in a very violent move into the 30s. And it's just, I trade silver very, very rarely, but it's just another chart that I'm trying to look at to give me definition and confirmation of the other charts on inflation. Basically, this is the highest, and I can mark it here. This is the highest close that we've had in terms of silver on a weekly basis. This is 26.19. I think if we have a higher close than 26.19, then that piece of the puzzle falls into place as well. And you know, how many pieces of a puzzle can you ignore before saying the market is screaming inflation? Onto the relative safe haven of equities. And if you think about it, this actually makes sense. If bonds are the worst, gold is in the middle, and equities are still the best, while gold, inflation, and bonds fight it out, people are not going to get out of equities. We have some very good definition in the SPX. We have our level 4180 and the one that we caught beautifully on last week, or was it Wednesday or something, 4129 and a half. You know, did it go through it maybe by a quarter of a tick and bounce straight up? It's, you know, the market is doing nothing wrong, and you cannot sell a market that's doing nothing wrong. There is absolutely, I mean, you can, but I mean, you're going to lose money. Until this market does something wrong, I will be in the Cooperman camp. I'm fully invested, but I hate it. Because there's absolutely no reason to do anything else. You stay fully invested, but you are very, very careful, and you are ready to bail out as soon as the market does something bad. Which basically means inflation stays low until, volatility stays low until it doesn't. You know, you're looking for the market, for the volatility level to confirm that nothing is going on in the market. Just as I told you last week, 2005 was the level in volatility, and unless it closed above it, you can forget about the market going down. That's exactly what happened. To me, if we look at all the different time frames, dailies, there is absolutely nothing in dailies, weeklies, whatever time frame you want to look at, which says the market is about to do something really bad. Until it breaks levels, there is absolutely no reason, excuse me, to think that we are in a reversal pattern. Certainly not in SPX. NQ, which we'll look at next, is a completely different story. Here is a weekly chart of NQ, and what you should actually be looking at is the fact that for the last 3 weeks, we've closed lower every week. Now, that compare and contrast that to what the SPX has done. 3 weeks of negative, and that basically is saying that NQ is anticipating higher yields, and certain parts of NQ do not like certain very large parts of NQ don't like higher yields and steeper yield curves. So that is, you know, that is very, very obvious. If we get rid of the weekly and go to the daily and the 195 minutes, we can see that we are beginning to do something wrong, but we haven't done anything wrong yet. This is on the dailies. We went through the Bollinger Bands. We could not sustain levels below the Bollinger Bands. We still have supporting MAs. They're supportive to the market, but the market is only bouncing to levels which are you know, where the market is no longer oversold and can be sold again. To me, it's quite obvious that NQ, from being a leader, has gone to nothing, and now could actually become a laggard or a leader to the downside. Depends which way the cookie crumbles, but this is the one that I'm watching very intently. And basically any closing below 13,312 is going to be very, very bad. I don't expect it to happen next week, but in the next couple of weeks, it could start setting up to do that. And that is then another confirmation of much higher bond yields, a much steeper curve, and a potential unraveling of the NQ. As I've been saying for a while, transports and Dow Jones Industrials are leaders in terms of indices. NQ cannot go down. It can go down on a spread. But what does that mean? It doesn't mean that it's in a bear market. It's just down on a spread against something. As long as transports and Dow Jones Industrials are in a fierce bull market, there's only so much downside in NQ. So what I'm saying is that these need to set up for a correction before NQ can really fall apart. Remember that. The indices need to be able to come down all at the same time. Some will then come down much more than others, but they need to be in a position to come down. To me, transports and Dow are still headed up, and that's why I just cannot get bearish of the market overall. And this is what is really going on in the US. Levitation of the indices and rotation because of these charts. This is XLF, XLK. It's now at this very important level that I showed you, 27.13. If we start breaking higher than this next week, that will mean that we are still in a laggard phase for NQ and a leader phase for Dow Jones, which is heavy in financials. Would it surprise me to go back to this area which was pre-pandemic? No, not really. You know, this is where the pandemic hit last year in this phase. So around the 30 level, could we go up there? Well, that is not a huge move from here, is it? So this is just basically confirmation that NQ is no longer the leader, and it is not yet the laggard, but it could become the laggard. This is the Qs against the SPY. It went exactly where I said it would go, to this 80 level. Could it now start, if it starts breaking this level, I think it's quite likely to go to 76, but these are not big moves in percentage points. So what this confirms what I just told you, that unless Dow transports are ready to take a 3, 4, 5% move down, the NQ can only move 1, 2% against them. So if Dow and transports come off 1%, NQ can come down 2, 3%, but it's not going to come down more than that. So all these indices need to be in a position to come down, and they are nowhere near that at the moment. It's going to take quite some time for that to happen. If we look at Europe, much the same is happening. We have a leader in the stocks above the DAX, but they're both heading higher. There's absolutely no doubt about that. To me, this chart, which I showed you a while back when it broke this 38.71 level, to me this is very, very indicative of what is happening at the moment. The monthly trends are very strong, and I have absolutely no reason to believe that we won't be trading here at 41.22 sometime, or 41.11, whatever it is, above 4100 sometime, possibly this month, and that eventually we are heading towards 45.12 in the stocks. I like the stocks. I don't see any problems with it, and that is why I think there will be this massive rotation out of European negative yielding bonds and into a strongly upwardly moving stocks. When you think about it, why on earth would you want to have negative to own negative yielding bonds, the only reason is because you think they're going to go more negative and you'll be able to sell them to the next bigger fool. If that is no longer the case and yields are moving higher, you want to rotate the hell out of them, because you are doubly losing. You're losing out on the opportunity to make money in something like stocks, which is going up, and you are absolutely guaranteed a capital loss one way or another on your negative yielding bonds. To me, EEM is still a laggard, but it's doing nothing wrong. As long as it's between 52.08 and 55.83, there's nothing much to write home about. I still think we will bust this level at some stage and try and test the highs. But if we have a look at it on a spread, it's not really doing very much positive. Against Japan, it's holding its own, but against EWG and especially FEZ, which is the stocks, it's actually beginning to lag quite badly. I don't think that this is going to be a major problem. We're going to have some very good support here around the 110 level, which is not even 1% away. And since I'm positive on stocks, I have to be positive on EEM as well. It's doing nothing wrong. I see absolutely no reason to think that as soon as the emergencies in COVID-19 in emerging markets like India are over, we will see a next upswing and move higher in EM relative to everything else, as well as just higher. The good thing about VIX is that we are now getting some excellent definition, and it just confirms to me that if we enlarge the daily chart, it just giving me treble confirmation of when not to be worried about equities. I think unless we get this close above 20.05, as I've said before, there's very, very little to worry about in terms of equities. I think the risk reward continues to be that we trade around the 1550 area in the days ahead, and that as a result we keep on seeing this slow grind up as financials, industrials and various other sectors compensate for any potential weakness in the technology and NQ area. That seems to be still the the path of least resistance and where the odds lie. That will change once we flip over 2005. We are nowhere near it. We're nowhere near it. We have no reason to think it's going to happen. And that tells us there's absolutely no need to anticipate anything, because this, I think, can only close above 2005 when all the indices are ready to come down. And as I showed you, the transports and the Dow are just not allowing any big moves to be sustained in any index. So for the time being, I really see no change here. I think still a gradual grind up as sector rotation levitates all these indices. Onto the summary chart. 2 stanza, I have changed it. I think if we start breaking above 148 basis points, as I said, 157 to me is almost a given. And 530s, if we start breaking 154 on a weekly basis, it's going to go a long way, and that is going to have repercussions, especially for NQ and the relationship between NQ and SPY. The dollar, to me, abandon all hope, all ye who are long. It's going to go down to this 89.80, 89.41 area at some stage, and possibly quite a bit lower. Is it going to happen next week? Not necessarily, but there you are. Gold, 1765 is the support. We haven't closed above it. I think the pressure now is for higher, But as I showed you, that very much depends on its relationship with TLT. I am still of the opinion that 1860, 1875 is going to be quite tough. But if we start breaking above that, I have to turn bullish. There is no other, that is what the market is telling me. It's telling me that we have lost faith in the Fed, and that could lead to a lot of volatility. That is why I'm still leaving VIX down here, 2005 being very important. Close above that, and I have to start flipping my views of equities, because it's obvious that something is going on, and I think this is going on, that the Fed has is beginning to lose the confidence of the markets. That to me is going to be very, very bad and very volatile in all asset classes. SPX, the definition is very good now. We have 41.80 and we have 41.29. I don't think we really need to think about anything. Below 41.80 leads to 41.29. Below 41.29 leads to hell. So it's going to be simple. I haven't really changed very much here because there's not a lot to change. NQ is just stuck in the mud because of bonds, and I've left all these levels in bonds, and I've also inserted DBC because I think another close above 1868, which is the high, will lead to much higher prices, as I showed you. Let's let it build a little bit of a little bit more definition in the weeks ahead, and that will be much better informed. Thank you very much indeed, and tweet you on Monday.